Good afternoon. Once again for business finance, I kind of said I'd go through Chapter 1 and Chapter 2. It's kind of optional whether you really want to listen to it or not. I just thought I'd whip through it for those of you that kind of learn in that fashion. Feel free. If you want to handle the quizzes and whatnot yourself, I really don't have any problems with that. So I'll be, actually there's quite a few. It's a PowerPoint and there's quite a few slides, but I'll try to go through them pretty quickly and apologize. But I guess in this format you can always stop and go back if you want to, so we'll give her a go anyhow. So we talk and you'll know, like my little cartoon that I have right on the front page there of the D2L has to do with economics and finance, because really until a while back, several decades ago, the two were kind of combined a little bit, if you want to call it that, or as we've evolved and created new stuff, new methods of analyzing and those types of things, maybe they've separated would be a better I don't know that they were necessarily combined. More things have been added. Now we can do a lot of things with financial management that we couldn't before, didn't need to, too. Taxes have changed dramatically, and things like that have made it more imperative that we have good financial management. So economics, though, they're still largely combined. And what's a good example of that? Let's say you're a financial manager, you're a CFO of a company, right? And I know you guys probably haven't been following this all that closely, but if you've seen what's been happening lately, for one, the price of oil has dropped. You guys have followed that because you've seen it at the gas station. Your price of gasoline's fallen from $3.50 or so a gallon down to $2 a gallon. Okay. But the other thing that you probably haven't been paying that much attention to is that the world economy outside of the United States is kind of suffering. The U.S. is apparently fairly strong. The American dollar has strengthened dramatically against foreign currencies. Okay. Now, if you're running the IGA store downtown here, might not be too big of a deal, right? If you're Caterpillar and half your business is done overseas, all of a sudden it's a huge deal. What's the huge deal? Well, all of a sudden, because the dollar's stronger and you're building equipment in dollars, in a sense, right? You're selling them and the other country's currency is weaker. What's that mean? Well, that means that it's going to cost more for those customers to buy your machinery at a time actually when their economy's not doing that good to begin with. So it really can have a dramatic impact on companies like that. Conversely, if we're here in the US, right, and our dollar's strong, what's happening to those imported goods? Those iPhones and whatnot that are made, they're Apple products, but they're made in China. Okay, what's happening there? They should be cheaper, right? Much like our oil is cheaper, even though a lot of it's imported, right? So those types of things have a huge impact then on projections and profit and all those other things that we have as financial managers that we try to keep track of, right? Accounting provides financial data through income statements, balance sheet statement, and cash flows. The three main financial statements. Finance links economic theory, of course, with accounting numbers, sure. Kind of an example of sometimes what happens, and if you follow the market all this week, Monday and Tuesday we saw huge declines in the Dow anyhow, and in the S&P, following some declines from the prior week, and so they're huge declines. Now what's happened the last 2 days? We've made back all the declines and we're actually back in good shape. Not that we were in bad shape, I guess. Okay, 1900s, right? Early 1900s, finance emerged as a separate field. 1930s, financial practices revolve around capital preservation. We want to maintain what we have, right? We also need to have liquidity. What's liquidity? It's ready cash, right? It's having that ready cash that you can go out and do things with, right? Reorganization of financially troubled corporations. Yeah, interesting. And then bankruptcy processes. We don't like to talk about bankruptcy all that often, but keep in mind Detroit. City of Detroit just went through bankruptcy, and I'll give you some other examples. General Motors went through bankruptcy. You guys don't remember, but Kmart went through bankruptcy, and then afterwards bought Sears, and now maybe they're both facing bankruptcy. Okay. Oh gosh, some of these oil companies, with the price of oil come down like this, especially some of the smaller ones, you'll see some of them filing for bankruptcy. 1950s, finance becomes more analytical. Okay, well, we were getting more tools too to be more analytical, right? Financial capital, money used to purchase real capital, long-term plant assets, real estate, equipment, those types of things, right? Cash and inventory management started to take shape. We started to become more concerned about cash and inventory management, where before that wasn't such a big deal. And even the last decade or two, we are still refining and redefining cash and inventory management. Think Walmart, think Amazon, and then think Alibaba. And there's huge differences actually between the three of those companies in that inventory management especially, but also maybe to some degree cash management, capital structure theory, debt or equity, right? Which do we want? Debt's always cheaper, but there's only so much debt that you can take, without having too much risk. And dividend policy, a good article I was just reading today had a lot to do with how the dividend play was deemed to be dead. You didn't want to purchase companies that paid dividends necessarily because they're going to stop growing, because rates should start going higher this year. Everybody's assuming that the Federal Reserve is going to start increasing rates, and rates should start going higher, and thus companies that pay dividends are a little less attractive versus growth companies, for example. So a little finance humor. It's hard to find finance humor. I hope the financial, well, I'm not going to tell a bad joke then on top of that. But so modern issues in finance, right? Risk return. Risk always goes with return, right? The higher the risk, the greater the return. But keep in mind that you're also saying the higher the risk. And so, more chance of going broke too, or going upside down. Maximizing return for a given risk level. That's really what we want to do, right? We want to take an acceptable amount of risk, and then we want to maximize our return within that acceptable amount of risk. Manage our portfolio, and portfolios for different companies mean lots of different things, and we'll talk about some of that as we go through class. And then capital structure, again, back to debt, equity, and even inside of debt and equity, there are divisions that you talk about, different types of debt, different types of equity, etc. There's new financial products with focus on hedging. This was part of the crisis. This was part of the 2007 crisis. The financial crisis was that, we did end up with a lot of financial products that had to do with hedging. And now I can't even remember the name of one of them. There were default swaps, and there was CSM, CSI. Shoot, isn't that terrible? It's only been 5-6 years, and it was a huge deal. And now I can't even remember what they were, but they were kind of a default swap type of a thing. And what I would say about this is that legitimate hedges are always wonderful, I think, and they're always they can generally be a good tool. An example of a good hedge is a farmer or rancher. Most of you will understand that. Say right now, at this time of the year, it's January, let's say they sold their crop, their 2015 crop, right? So they're going to deliver it next October, next September, next August, and they're going to get X for it. Maybe it's $6 a bushel. Well, what's their risk? Well, their downside risk is now gone, right? They've sold their crop. Of course, they have the risk that they won't grow the crop, but we can do little about that with hedging. But what's the other risk? Well, the other risk is that in the meantime, the price of grain, maybe it goes sky high, maybe it goes to $12, and so you just missed out on $6 of profit, and all of that would be profit, because you sold too early. You can hedge, or you can buy, I think in that case you'd buy a call option to hedge that bet, okay, so that if the price does go up, you'd still take advantage of that, even though your wheat was already sold. So that's an example, and those are legitimate hedges that good financial managers use. We don't talk a lot about hedges when we go through this, and frankly, hedges are something I wish I knew more about. Okay, I had customers that did some hedging and whatnot when I was in the banking world, and I didn't know enough about it. Sometimes they'd come in, I'd ply them for as much information as I could get without looking stupid myself. But it is something that I wish I knew a little bit more about. I just know enough to be dangerous, maybe. Inflation, key variable, right? In financial decisions. What's going to happen? Again, the value of the dollar, value of those types of things have to do with inflation. So a lot of that's been in the news over the last week or two. It's more modern issues, right? Effects of inflation, deflation. They're really, really concerned about deflation over in Europe. Required rates of return for capital budgeting. That's kind of like a discount rate that we use. We'll talk a lot about discount rates as we go along. And then cost of capital, or weighted cost of capital, when you figure both your cost of equity and or your cost of debt. Here we go. This one's not so appropriate anymore. It's not that it's a bad joke or anything. It's just that with gasoline at $2 a gallon, we don't feel like we have to go to the banker and get a loan anymore as we did when it was over $4 at one time, right? It's really, I'm not going to say it's pleasant to go and fill up the car, but it's less unpleasant to go fill up the car when you realize that a 15-gallon tank of gas you're saving, what the heck? Almost $25 maybe, 25 bucks when you fill up that sucker. Sweet. Risk management and the financial crisis, right? The reason for the recent financial crisis, unwarranted extension of credit, absolutely. Lax standards. You can point fingers, the government, financial institutions, Fannie Mae, Freddie Mac, all of those things, right, contributed, along with the the sale of mortgage-backed securities. I would enjoy teaching a whole class. I could teach a whole semester on the 2007 financial crisis and what happened and whatnot. I didn't enjoy being in it or being a part of it, as my stock portfolio continued to decrease in value. But it's kind of cool to look back and see what the causes and effects were of the financial crisis now that we've kind of gone past it, and hopefully we can avoid those mistakes in the future, right? Losses from credit defaults in excess of banks' capital in many cases, and that's really what triggered the bank bailout that you hear about. Banks on their books, at least on their books, looked like that they had zero equity, and a bank, frankly, doesn't need any equity. If you want to throw that out there, they, think about it like this: if one of you deposited $100 with my bank and I lent it out to another one of you for $100, I would pay the one 2% interest on his deposit, and I'd charge the other one 7% interest on his loan, and the difference is 5%, or the net interest margin that the bank would make. And I don't really have to have any capital to get that done, other than there are regulatory requirements for capital. Okay, so there's regulatory requirements for capital, and when I fall below those, the regulators come knocking, as right they should. And so that's kind of what happened, and that's where the government stepped in and sort of kind of bailed out the banks. Yeah, we could argue again about the total necessity of that and whatnot. And my take on it might be somewhat different than other people's. So, credit default swaps, that's what I was looking for. CDSs, thank you. PowerPoint. Creation of complicated, unregulated financial products like credit default swaps. Default swaps were interesting. That was like buying insurance on your neighbor, right? And buying life insurance on your neighbor, a big amount, and then you kind of got a vested interest in him dying, right? And credit default swaps were a little bit like that. Companies were buying credit default swaps in other companies, and honestly, they kind of had a vested interest in that other company dying or going broke, and there ended up being a spiral that was kind of caused by those. It was kind of unfortunate. So We had government action and bailouts, of course. They'll be talking about these for decades, the government action and bailouts and the necessity or non-necessity of those things and the effectiveness of them or non-effectiveness of them. Out of all that, did we get new regulations for financial institutions? That's where we say, OMG, did we get new? We, for example, got something they call the Dodd-Frank Act. I tend to refer to it as Franken-Dodd. There's actually some components of it that aren't too bad, but there's some things that are a little bit frightening. But so Franken-Dodd was passed, obviously, in response to the financial crisis. It purports to improve accountability and transparency. Yeah, we'll see over time, right? Financial Stability Oversight Council and Office of Financial Research kind of set that up, right? Created to maintain stability of the financial system, yeah, or at least that's what it's purported to do. This part's kind of important. I don't necessarily, this is one of those I don't necessarily disagree with, right? Provides for orderly bankruptcy or liquidation of non-bank financial companies. Used to be a law in the books years and years and years and years and years ago, came out of the Depression, was called Glass-Steagall, and banks had to be separate from other types of operations. So a bank was a bank was a bank. In other words, banks, being a former banker, we took in deposits and we lent out money, and that was basically what a bank did. And we were prohibited from doing other things, maybe like insurance and selling other investment vehicles and different things like that. And there was a wall. Okay, there was basically a wall that was created to make that happen. And what they wanted to do is they didn't want depositors' money being used for some of these other more speculative types of things. And the wall was not necessarily a bad wall. Okay, I don't necessarily, when I was in banking, sure, I always wished that we could do more things, but in retrospect, I don't know that the wall was that bad of a thing. And so what happened was they got rid of Glass-Steagall years ago, I probably was still in banking when they started relaxing some of Glass-Steagall. So it's been quite a while ago. And guess what? Banks got into all kinds of other activities then, and some of them that were a little bit more speculative. And so what happened? Remember that banks are highly regulated, and banks also have FDIC insurance, and your deposits are guaranteed, and on and on and on. So the government has a vested interest, and rightfully so, in watching banks, making sure banks perform appropriately. And banks didn't. Okay, and they got into other things, and it was the other things that really created the problems. It wasn't the traditional businesses that banks were in, borrowing or getting deposits and lending money. So we set up under Dodd-Frank a way to liquidate or bankrupt, businesses that were outside of the normal banking deal. Consolidated some regulators because there was lots of regulators. What that probably means is there was regulator for banking, and then there were regulators outside of banking, and so this probably put them together, right? Hedge funds, investments advisors must register with the SEC, sure. The Federal Insurance Office, I don't know a lot about that. The Volcker Rule kind of reestablished Glass-Steagall, but not to the same extent. So now there is limits on speculative investing by regulated institutions. So if you're regulated under the banking laws, if you're considered a bank, right, either under the FDIC or the Federal Reserve, then you're kind of limited as to what you can do. A good example of that is that the one big bank that had the least problems in the financial crisis was Wells Fargo. Wells Fargo has generally been a conventional bank. Okay, they didn't, even after the Glass-Steagall kind of went away, Wells Fargo never really went into a lot of the speculative things like the other banks did. Okay, and as a result, Wells weathered the storm pretty well if you went back and you look at the history of it. And in fact, in the bailout, Wells was forced to take the bailout, even though they didn't want to, and nor did they need to, and nor had their capital fallen below the regulatory requirements. They were actually forced to take a bailout and be a little bit more under the control of the government. So, okay. It also set up the Bureau of Consumer Financial Protection. This is the one that scares me the most because in talking to some of my old banking buddies and whatnot, this is making it more difficult for consumers to get loans. Just, in a nutshell, it's making it more difficult for consumers to get loans. And banks have, we've gone through different types of regulatory processes. We did when I was there too. And the end result of all of them is that it it continues to raise the bar, unfortunately. Banks, and I felt our bank used to really work hard to try to, get outside the box and make some loans that were kind of exceptions. But then, when something happens and they bring in more regulations, guess what goes away? The ones on the lower end, the ones that you're truly trying to help, and that oftentimes really need the help. Okay, and so then bankers end up catering to the haves, and the have-nots end up finding credit at pawn shops and payday loan places and those types of things. So it's this is where I would probably argue that the consumer financial protection isn't always the right type of protection that we ought to have. So impact of the internet. Wow. Sorry, this thing operates a little bit slow. Internet accelerates, yeah. E-commerce for old company, yeah. You guys know this more than me. Amazon, eBay. I don't even need to talk about some of those things, right? Alibaba, Walmart.com. Who doesn't, when you need something, who doesn't go to the internet first and kind of look it up? I do. Oftentimes, even if I end up going uptown, and I do try to go uptown and still make my purchases and whatnot at the local places, but I'll still look it up, try to see what the price is, make sure that what I'm paying isn't completely out of whack, on and on and on, right? Pattern and speech, or the B2C model, or business to consumer, right? Which is your Amazon. B2B model is business to business. This is the part that most of us don't see. But this is actually a bigger part than this. We see Amazon, we see how big Amazon is, and we see all the consumer products and stuff that are sold there. But the B2B is what's amazing. Lower cost of managing inventory. Because imagine, if I told you how we used to have to order when I worked in retail when I went to college. I mean, we went through manually and calculated what we needed of certain products and whatnot when they were getting low. And we would carry 10 products of something, and because it would take us a month to get in more, and it was really a pain. And so we'd physically go through, we would have to write it down, or we'd pull tags is what we had, to determine that we needed to order certain things. They were snail mailed then to the place, and then they had to get put together. Those orders had to get put together, and then those things delivered. Now, literally, if you go to Haver Hardware and you check out, and they zap you with the laser thing, they zap your product with the laser thing, it automatically puts in place a reorder, and that product will probably be in the store like the next Tuesday is what they usually tell me, okay, because it's automatically zapped someplace else, and away it goes. Well, do you think that Haver Hardware then needs to have a dozen things on a peg? No, they have 2 or 3. Well, imagine what that's done in terms of lowering their inventory costs. It's just amazing, right? Accounts receivable too. Okay, and a lot of this has to do with factoring organizations. In other words, like when I charge things at Haver Home, I don't end up getting a bill from Haver Home. Maybe they've changed back, but when Barkus had it, I'd get a bill from Farm Plan, or what ended up becoming John Deere Credit. Why is that? Well, as soon as I signed the bill, they'd send that into John Deere Credit, and John Deere Credit give them the money, and then John Deere Credit became responsible for collecting from me, right? And it's kind of an interesting way, and things like that couldn't have happened before the internet. So financial management concerned with managing entities' money, yeah, we kind of talked about that, right? Allocate funds to current or fixed assets. What do we need? Again, it depends so much on the organization. Some organizations need almost no current assets, but lots of fixed assets, and some are just the opposite. So best mix of financing alternatives, appropriate dividend policy, yeah. This can really change, with different corporations, and you guys will see that probably when you're studying the companies that you do for Project 2, right? With the dividend policy, a great example is Berkshire Hathaway, who most of you know I like and I like to follow, has never paid a dividend, and nor would I want him to pay a dividend, right? If he pays a dividend, he's giving my money back to me, and then I got to go find someplace else to invest it, right? I can't think of anybody that can do a better job of investing my money than Warren Buffett, so why don't I just leave it with him, okay? Versus some other companies, I'm happy to get my dividend, right? Daily, occasional, different things that you do then as a financial person, right? Risk return, boy, that's everything. influences the operational side, capital versus labor, A versus B. What do we do? Influences the financial mix, stocks versus bonds, or debt versus equity is what that is, versus retained earnings. Which has to do with the dividend policy. Do we pay it all out? Do we keep it? On and on and on. Forms of organization, you guys have been through this in other classes. So proprietorship's the most common, right? Partnerships, lots of different types of partnerships too. There's general limited, limited liability, family limited liability, professional limited liability partnerships, on and on and on. Okay, limited partner. You guys can read through those things. Corporations, right? And when we get to Project 2, you guys will all be doing corporations because they're publicly held. And so they're C Corps is what they'll be. And so we get to study those things. Almost all of them are C Corps. There's some others that potentially might not be, but we'll see. Key features, yeah. You guys can kind of read through some of these. Probably the most common new type of organizational form is limited liability company, or an LLC. They've kind of taken off. They kind of contain the best advantages of all, I would say anyhow, of all the different forms. I mean, you can kind of be a partnership. You can sell members, is what they call them. They can have unequal shares. Their liabilities limited. They don't have double taxation like a C corporation. On and on and on. So. And that is a big disadvantage, by the way, of C corporations, is the double taxation. That might be one of your questions. S corporations, on the other hand, are just like any corporation, except they don't have the double taxation. And when we get to that, I think we get to a section on that later in the book, or later in the course, and we'll talk more about that. Agency theory, we talk about that in law and whatnot a little bit. So. Owners, managers, institutional investors are getting to be kind of interesting. It's interesting to follow. A lot more people are investing in things called mutual funds and ETFs, or exchange traded funds, and that, if I'm an individual investor and I buy 100 shares of Berkshire Hathaway, my share of the company is infinitesimal, right? It's just tiny compared to what the company's valued at. And I still have every right to go to the stockholders meeting. I can express my opinion. I can do those types of things, but I don't carry a lot of weight. On the other hand, if I buy a mutual fund that happens to own Berkshire Hathaway, and there's a gazillion other people that buy in that mutual fund, and so they own Berkshire Hathaway, all of a sudden that mutual fund might own 5% of Berkshire Hathaway's outstanding stock, and that would be a huge chunk. Not quite as much as Warren himself owns, but it would still be a rather large chunk. And when that person that represents that mutual fund and or ETF shows up, they would carry some weight when it was time to vote on different issues and whatnot. And so they can actually make some things happen, which is kind of an interesting concept, and how that's changed in the last couple of decades. 3 or 4 decades ago, we didn't have mutual funds or ETFs, those types of combined things. And we'll talk about those too, I think, as the class goes on, especially as we get into the end and start talking about your project. Sarbanes-Oxley came out of the Enron scandal, so about the mid 2000s, prior to the financial crisis of 2007. We had another kind of a scandal, I guess you would say, where it turns out companies were kind of cooking the books. Unfortunately, they weren't doing things properly, and so Sarbanes-Oxley came in and tried to correct some of those things, and probably did, some of them. Goals, right? Maximization of profit, maximization of shareholder value. That's what I would say. Shareholder return, maybe even, right? Okay. Some drawbacks, right? When you're maximizing profit, a change in profit may also represent a change in risk, right? You start taking on more profit, you might be taking on more risk, right? Fails to consider, it can, when you're taking maximization of profit, it fails to consider timing of benefits, benefits to the company, to shareholders, those types of things, right? In other words, you might be showing a profit this quarter, and it might have been better to show it next quarter for tax reasons and those types of things. But anyhow, impossible task of accurately measuring key variable profits. So it's And when we do the books, when we do accounting things and whatnot, it seems pretty easy, right? You got your sales minus your cost of goods sold minus your operational expenses, gives you, EBIT, or earnings before interest and taxes. Subtract your interest, subtract your taxes, and you got your net income, right? That seems so easy. It gets far more complicated when you get into into bigger companies and you start dealing with different tax laws and those types of things, some of which we'll touch on as we go through class. So broader goal, and that was kind of what I said, maximizing shareholder wealth, right? Achieve the highest possible value for the firm and for the shareholders. Possible value for the firm, yes, but the dividend policy can make this a little different. You might not have as high value for the firm, but shareholder wealth might be better improved by paying a dividend. Again, it depends so much on the type of company and whatnot. One way to retain power in the long run is becoming sensitive to shareholder concerns, of course. Stock option incentives, although these got a little bit wacky at times. There were some companies that went a little overboard on stock options, and while stock options are great and it motivates employees, it also dilutes the shares that are outstanding for the shareholders that are out there. And so there's a good and a bad. Powerful institutional investors, again, that's what I was talking about when we talked about mutual funds and ETFs and stuff. So ultimate measure, the valuation approach, how earnings are valued by the investor and future earnings, right? A company's, what Warren would say is that a company's really worth the net present value of its future cash flows, right? And that's basically true, right? And so that's one method of valuation, I guess. But then you've got to look at risk. You got to look at all those other things, right? Time, over which some of these things are going to happen, long-term, short-term, because the different companies are way different, right? Quality and reliability of reported earnings, right? Trying to think of good examples. Right now, oil companies, if you took a look at some of those, especially the smaller ones and whatnot that don't have refining and stuff, it's going to get really ugly, right? So the quality is going to be poor and the reliability is going to be poor. Now, if you're a betting person, when it hits bottom, if we're close to bottom, you might think, might be a good chance because they're probably going to go up, right? Sure, financial, yep. This is saying that financial managers participate in those decisions all the time, right? What's the? You're looking at the different alternatives. One example I always throw out is buying or leasing equipment. Just for an example, right? Leasing long-term, renting short-term, those types of things, and it depends on the type of company, the projects that you have, et cetera, et cetera. So, social responsibility. Now, my favorite economist, and I'm not saying that I totally agreed with this part of what he said, but my favorite economist, Milton Friedman, always said that the business's sole social responsibility is to make money. Let the government take care of other things. In other words, government should set environmental policy and those types of things, and the business should comply with the law, but shouldn't really spend a lot of time or effort trying to do anything otherwise. So his was an interesting take on it. I don't know, like I said, if I necessarily agree with all of it, but social responsibility, it can be a positive, though, for companies. Companies that have good social policy seem to attract investors, employees, those types of things, right? So, this talks about government regulation, basically, and why some companies like government regulation, because then the burden falls on everybody as opposed to them just being the only ones that are good, good stewards, say, of the land or the environment. So, insider trading. Wow, we hear some about this. This has kind of fallen a little bit by the wayside. There's been some. You guys probably don't follow it. In the last 3 or 4 years, they've been very aggressive at going after some insider trading and whatnot, and it's been kind of interesting. It's probably why we're not hearing a lot now, because there were some high-profile cases, and the government actually did a pretty good job of prosecuting some people. Those people that might engage in that are giving it a second thought now, right? And insider trading is using information that's not available to buy or sell in the short term, right? And make money, okay? And make money in the short term, okay? it gets to be a little bit difficult, because if you're working at XYZ Corporation, should you own stock in XYZ Corporation? Absolutely, you should. You should buy it, and you know, nobody should really care about that, right? Okay, and maybe you should sell it on occasion if you want to diversify or do some other things, and there shouldn't be any problems with those things. But if you know, for example, that you know, one of your products, if you work at GM and you find out that one of your major cars is going to suffer a major recall, you know, what's that going to do to the stock? It's probably going to go down. So if all of a sudden the night before that announcement you're selling all your stock, right, and then you're buying it back after the announcement, yeah, you know, might not be a good thing, and that would probably be considered insider trading. Role of financial markets. Yeah, and what do we talk about? Financial markets. Stock market. I mean, there's one. I mean, it's broader than that, but the stock market is one. Serve as indicators for maximizing shareholder value, right? Report ethical or unethical behavior that influences company values. So we're watching companies all the time, right? Participants can be individuals or public, private, government institutions, right, that buy, sell stocks and bonds, right? Public financial markets. And corporate financial markets. Probably more when we talk about corporate financial markets, we're talking about the bond markets and whatnot, and some of the trades and whatnot that go on there that are a little bit out of the public sphere, perhaps. There's domestic and international markets. When you guys decide to do your second project and you have to pick a company, some of you may want to do a foreign company. I'll probably discourage that. I don't know that the information is as available as what we'd like to see. Versus American companies where the information is widely available. But it's really easy to buy companies that are listed in foreign exchanges. You know, I could call my stockbroker today, and when their markets are open anyhow, you know, he could execute trades for me for a lot of different companies that are actually foreign companies, right? And then there are a lot of foreign companies that are even listed here in the United States. Okay, so they sell their stock on the New York Stock Exchange or on the NASDAQ, right? Lots of them. Yeah, one good example is InBev, right? InBev makes Budweiser, the great American beer. It's actually owned by a Belgian company, which trades on the New York Stock Exchange. Interesting. And still has the ticker symbol BUD. Yeah, cool. Corporate and government markets. We talk about, again, bonds and whatnot, particularly. The government's, you know, big into bonds, right? Government borrows more money than anything else, $17 trillion or something like that, right? Then money and capital markets have to do with, again, there's primary and secondary markets for buying, or primary markets are for selling stock, basically, or for you and I to be able to buy it of companies that want to go public. So we'll talk about that here in a little bit. Money markets deal short-term securities, right? So companies borrow sometimes in the short term because they need to, just for short-term purposes and whatnot. Securities can include commercial paper sold by corporations to finance daily operations, so they'll do that, right? Certificates of deposit with maturities of less than 12 months sold by banks. That's money markets. That's short term. Certainly banks issue certificates of deposit that are longer term, right? And companies issue bonds that are longer term than that as well, which are called bonds. So capital markets deal with things that have a greater maturity than 1 year. Stock, preferred stock, corporate and government bonds, allocation of capital. The primary market deals with when companies go public. Recent examples be Twitter went public not all that long ago. Facebook was only a year and a half, 2 years ago. Okay, so not all that long ago that it went public. I'm trying to think some other companies. One that's rumored to be going public possibly is Uber. I'm not sure that there's any plans necessarily in the works. I'm trying to think if there's some other ones that you guys would know that have gone public here recently. Yeah. Secondary market is what you and I would more than likely participate in. If we wanted to go buy a share of Google, okay, call up our stockbroker, we buy Google, right? And that's the secondary market. They went IPO a long time ago, 6-7 years ago, but that doesn't mean you and I still can't buy and sell, trade their stock, and so that's the secondary market when we would do that. Stock or bonds or preferred stock too. So yeah, investors can choose risk level, so that's going to be interesting when you guys do your report, right? You guys will talk about the risk, of your companies and whatnot, and also the potential returns. Companies that reward with high-priced securities can raise new funds, money capital markets. Sure, it's a lower cost, right? Because their stock is so valued. And again, later in the class, we'll go through lots of examples of that, different companies and what they're priced at and why they might be priced at that, et cetera, et cetera. But Google, for example, has a lot higher price than Microsoft. Apple, let me think. Facebook probably has a lot higher price than Apple. Maybe Google, when you compare it in relative terms. Firms definitely pay a penalty for failing to perform, and anymore, because of the proliferation of the internet and other information and whatnot, the penalty's rapid, right? If you miss a quarter, miss your earnings for a quarter, the market can just pummel you. So restructuring, you'll hear about companies going through restructuring. One that I just read about is kind of interesting. The reason it's kind of interesting, I remember, oh golly, what's it been? Probably 5-6 years ago, when one of your fellow students was doing the project 2. They chose a company called Wet Seal, and I just noticed yesterday some headlines said Wet Seal is restructuring. They're closing a bunch of stores. They're going through some different things like that, right? So they're changing the capital structure. They're getting rid of some equity things, maybe some assets that are on the balance sheet. Maybe they're going to sell off some debt, or not sell off, but sell off some assets and pay down some debt and do some things like that, right? I wouldn't doubt that they're also going to remove some current management and shrink their, certainly going to get rid of some employees. I just saw where, what was it? Coca-Cola is going to get rid of some, as is, oh gosh, who is the other company that's going to cut some costs? Coca-Cola was one. Another major company, anyhow, that you kind of wouldn't think. JCPenney's been going through restructuring for about the last 5 years. Sorry, I don't mean to laugh. Sears/Kmart is, also kind of like JCPenney's, and going through almost this permanent state of restructuring, which is interesting in retail. Retail's an interesting game. Also includes mergers and acquisitions. Actually, M&A, or merger and acquisition activity, has been picking up this year. That's usually a good sign, so at least in the U.S. So search for lower cost sources of financing, absolutely. There's all kinds of money out there outside of the United States, and there's nothing wrong with trying to take advantage of that and trying to get some of that in to the U.S. and use that for our companies, right? Impact of international affairs. Wow, yeah. We have to understand international capital flows, computerized electronic tax systems in the various countries, on and on and on and on. Foreign currency hedging strategies. So yeah, so with the euro's going down, and probably the Asian, the yen and the yuan are probably going down against the U.S. dollar. How do you hedge against that? Frankly, I don't know. But if you're a financial manager that's dealing in that type of a company, you would know, right? Hopefully you would know. Cost reductions in trading securities, yeah. There's been so many changes. Of course, we can just do that online now, right? Major stock markets and mergers of brokerage firms has happened to a certain extent, but there's also there's kind of new ones, that small ones, that have been boutique firms that kind of have come up to. Electronic communication, yeah, we all do that, right? Electronic markets, again, we can do. You guys, I don't know if you want to watch a good old movie. It's called Trading Places. Now, it had to do with commodity exchange. You could talk to Rod about it too, and literally they used to place their orders using hand signals and whatnot. And those guys yelling and screaming, and yes, they were guys on the floor. I mean, that was real. That's how they traded commodities and stocks and bonds and those types of things, using those hand signals. It was amazing how they were able to do that, and actually for its day relatively efficient. But of course now all that's done on computers and is even more efficient. Oh, there we go. Okay, long enough, I'm sure. If I can get this thing to exit, I'll close this thing out and bid you guys adieu, and tell you good luck on the #1 quiz. And I'll probably do one of these for chapter 2, and once again, you guys can decide whether you think it's useful or not when you do the quizzes.